Morning Trade Live. It's time to go inside out on retail. Joining me right here on set, Sveta Kalinska is with us, consulting founder and CEO at RILA Global. Did you say RILA or RILA?
RILA Global.
RILA Global. Thank you, Sveta, for being here. First time in person, and we have a lot to discuss. I know we have some stories, specific stories, but first let's just hit the retail sales story. Big picture is that it comes in a little weaker than expected. Is it a one-off? Is there, when you see a miss or some weakness, what does it tell you here?
So I'm not a financial expert or an analyst, but I analyze consumers. So when I look at this financial picture, I first think about the consumers and what they have talked about online in the last few months, basically last quarter. What I've seen is that across all retail, any of the brands that we're going to talk about, they have mentioned, of course, the tariffs and how much they have been impacted in their day-to-day by those tariffs, and again, prices. Like, where are those retailers heading when it comes to the cost that the consumers will have to spend when they go and shop at any of them?
So the consumers are already complaining and concerned about price increases. Are they seeing those price increases, in fact?
Yes, they are. So the U.S. consumer just in the last month has gone on a social media channel and posted that they're feeling the burn. Especially now, actually, I know it's only June, but parents are already talking about being back to school. And with the approaching upcoming holiday campaigns towards the end of the year, some people are actually stocking up and doing their early shopping now. So consumers are feeling the burn. Some of the retailers and during the earnings calls did mention that they are very aware and not looking to increase prices, and the price increase would be last. That's what actually the CEO of Target had mentioned during the earnings call. But yeah, consumers
Walmart had that, and actually President Trump said, you better eat some of the costs. And it's going to be up to each retailer. I mean, the big ones have a little more leeway. The Amazons, they have some leeway between their suppliers and themselves and the money they have on how much they actually raise prices. I did actually read something this morning from RD Solutions saying that 86%, I had to comb through this because there were different parts of this, but it said that many people, I'll just say, it did say 86%, were ditching the brand names at the grocery store for some of the private label. 11% were definitely not changing. Some were changing depending on what store they were. So there were some caveats, but I think the trend is the trend, and that is that people are seeing the price increases and they're now going to private label. They don't really need their specific brand name anymore.
Oh yeah, absolutely. I mean, many of the consumers from the analysis of the data that we did say that they are ditching the label. And now with e-commerce, I mean, again, these retailers, they're not only brick and mortar, I mean, they have massive earnings coming just from e-commerce. Basically, consumers are able to really fast check and see who has the best price for the item that they're after and just go with them. And it really comes down to who has the, what's the cost, best price, and also advertising. How are these companies advertising to the same consumers, because they're all trying to reach the same audience.
So as we talk about the different types of strategies here, I mean, obviously if you have an e-commerce strategy or you're sort of an omni-channel or something and you have curbside pickup and all these things, I mean, that helps, right?
Oh, yeah, absolutely.
Are there leaders in your mind on the ones that seem to get the picture right?
I think all of them are on the right track. Maybe not so much about Target. Probably Target would be the last. I think they're just experiencing some headwinds. When it comes to a favorite pick of mine, or one that I think is really at the forefront and forward thinking, I would definitely say Walmart, and I'll tell you why. So these earnings that were announced for all three companies, Amazon, Target, and Walmart, did comprise of a huge portion of the revenue for their global ad business. Now listen to this. I think this is actually a topic that investors don't really understand so much because they're so focused on the finance. But Walmart actually purchased Vizio hardware TV for $2.3 billion just about 2 years ago. And this is actually in a decision or a desire to move and become like a Prime and really head towards the advertising business more so than any other of their businesses and other revenue streams that they have. So now they're really entering this OTT space, over the top and streaming, much harder than any other retail. So they're not only the brick and mortar representation of a brand that has multiple lines of businesses, now they're actually entering with the big dogs when it comes to streaming. So the streaming space, the TV space, which we know is huge when it comes to earnings potential, but also where the consumer is headed. I mean, think about basically understanding your consumer to the point from turning on your TV and knowing how much you're watching from a specific network or a specific show, to basically being able to pick up that same app and see whether in the specific TV segment you are targeted with a product, and then how you actually convert it. So what happened bottom of the funnel? So how do we measure that conversion and that awareness from TV to product presentation to the consumer to the actual conversion?
Exciting. Look, innovation there, and you're bringing it to us in a way that we can understand and have that foresight. You said it's a $2.3 billion acquisition. You did note that Walmart's e-commerce sales have grown by 22%. I mean, that's a pretty significant number, and Walmart was the one name that everybody said could take on Amazon, and it certainly appears like they are doing so. What are your thoughts on Amazon? You noted some record numbers here and growth.
Yeah, so Amazon specifically, I mean, when it comes to obviously retail and the retail arm of their business, because they're a huge company, I think they're still in a very, very strong position. They are number one, as we know, when it comes to consumer preferences and shopping habits. So I do think they're very well positioned to continue that growth. And the interesting thing that I would like to point out from the earnings call specifically was that the Amazon CEO had pointed, obviously they're in a very strong position, they're continuing innovation, and now they're really focused on AI. So how can they continue innovating everything that they've built through Prime, through apps, and through other, Whole Foods, other lines of service and business that they have, and how can they continue that expansion? And that is really going to come from the AI agentic workflows and the AI innovation.
Right.
So they will be, while they're a little bit behind now on AI specifically in the AI economy, they're putting in infrastructure in place, they're putting in application and the forward-thinking forefront of how they can actually become a dominant retailer with multi-strategy between all channels.
Any telling on back to school or you mentioned it briefly, back to school or holiday sales projections? Are we expecting year over year, like the holidays? Remember we used to say, it's up 3% year over year. I mean, are we having any expectations yet of improvement year over year yet, or it's too early to tell?
I think the word improvement is a very optimistic one, given, of course, the environment that we're in. So what I've seen from consumers, and again, it's only the month of June, but parents are actually stocking up and have started stocking up on products back in March, back when the tariff announcement happened.
So they want to be more careful.
Yeah, absolutely.
Frugal.
I mean, I'm a parent myself, so I am on the same boat, and I totally get it.
Yeah. I'm happy I don't have to do back to school anymore. Sveta. Thank you. It's wonderful to see you in person. You come with a wealth of knowledge. We really appreciate it. Sveta Kalinska of Rela Global, thank you. All right, so Tom White is with us, host of Fast Market, and we want to get to the trades. Walmart with a great story and obviously really getting all those consumers. Tell me a little bit about the trade, the example trade that you are putting here for us today.
Yeah, the stock's had a pretty good run over the last 12 months, up about 40%, but it's pulled back, from those all-time highs of above $105 a share, but it has rebounded from those April lows. So I looked at something that's a little bit more conservative, where I can take advantage of yield, not only from an out-of-the-money call, but also from the dividend payment, which is about 1% dividend yield on this name. So for every 100 shares of stock you buy here in Walmart, we're going to sell an upside call against it. I looked at selling the July 18th, the monthly options that expire in 31 days, the 97.5 strike call, so out of the money by a few bucks to the upside here. You're going to pay a debit of around $92.80 for it. So you're buying the shares at over a 1% discount to where it's currently trading because you're selling that upside call. Now, if you pay $92.80 for this, that's also your break even to the downside. You get to collect that dividend yield on this one. And then as you get closer to expiration over the next month, you'll be able to buy that short call back, roll it out to another weekly or monthly cycle. So the idea is to keep the position open, keep long the shares to collect that dividend, and then continue to collect credits, which lowers your break even, increases potential profitability on this one. But a little bit more conservative, taking advantage of yield, not only from the dividend, but those out-of-the-money calls that you sell against it, you can always close those calls early if the stock does continue to move higher, so you don't get your shares taken away from you also. So keep that in mind on a strategy like this, but maybe a little bit more conservative here with the covered call strategy in Walmart.
All right, thank you for that. And then we get to the Amazon example trade that you've brought to us today.
Yeah, this stock basically flat on the year now after a pretty good run from those April lows that we've seen. Still below all-time highs of that we hit about $242 at the beginning of February. So take that into consideration. It's pulled back pretty significantly. But if you look at their silos of revenue generation, whether it's AWS, which continues to grow and be the leader in that space, retail is still doing well, even though we got a downbeat retail sales data. They did announce their Prime days in July. They're extending it to 4 straight days. So I looked at something a little bit more aggressive because implied volatility levels on this rebound that we've seen in Amazon from those April lows, the IV percentile ranked down at 15%. So we're in the, the bottom, basically 1/6 of implied volatility levels over the past 52 weeks. So as we've gone higher, implied volatility levels come down. So I looked at a strategy that takes advantage of that low implied volatility while still taking a directional bias on this one. I went out to that same July 18th monthly option series that expires in 31 days. We're going to buy an at-the-money call vertical here where I can offset some of my costs on this bullish trade. We're going to buy the 215 strike call, and then against it, sell the 230 strike call. You want it to go up to 230 to get max profitability on this one. $15 wide bullish call vertical. You're paying roughly about a $5.80 debit. It's probably closer to $6 right now because the stock has moved higher. But the debit you pay is going to be your risk. So if you do pay $5.80, there's your risk, $580 per spread. Takes your break even up to $220.80. That's less than 2.5% above the current share price. So you only need about a 2% move to get above that break even. Anything above that break even is going to be profitability on this one. You're risking about $5.80 to make about $9.20 on this if it expands to $15 and goes above $2.30. But those low implied volatility levels allow you to get into a bullish trade like this at a lower cost entry point, which means your risk is lower on this bullish trade.
All right. Tom White, thank you for both of those example trades on the day that we got in our retail sales showing some weakness, but some example trades for you folks on both Walmart and Amazon. Thank you, Tom White.